Guys, welcome. Happy Friday. So I'm looking at what moved today in particular, Daniel, and I see underneath tech and comm services, security, Zscaler, Palo Alto Networks, CrowdStrike, some of the big cloud names, and AI hardware, including NVIDIA, Supermicro, even Intel higher. Where do you go from here after these kinds of gains if you were holding these, and can you chase them if you weren't?
Sure, John, and happy Friday. Thanks for having me on. So look, the last couple of days has seen a vicious rotation into the laggards, right? The small caps, the higher beta, cyclicals, the leveraged stocks within the market. And that's following, of course, what had been obviously a tumultuous year for those types of stocks versus the Magnificent Seven. So look, I think it's only natural that you're now going to see, frankly, a little bit of rotation back into quality, into growthier ideas, and into ideas tied to secular trends such as cybersecurity, right? As the digital economy continues to expand, as cloud expands, cyber continues to be a theme that I think will have enduring growth and certainly earnings power. And I think lastly, as we look to next year, we're going to get in January just a glimpse of just how sustainable some of these rotations are. And from my own personal perspective, we still like tilting towards some of these quality growth ideas like Palo Alto within cyber.
Wow. Okay. So maybe following up on that idea, Barry, you say that Wednesday's Fed meeting changed the rules of the game, and maybe in a way that's good for equities. How?
Well, in September, which I thought that the September SEP forecast, the framework that Chairman Powell created, was a hawkish mistake. At the time, we were in the midst of a bear steepening, supply-driven bear steepening in the yield curve. The deeply inverted curve is a massive problem for the small banks in particular, and then the areas of the economy they finance, like multifamily real estate, small businesses, and even the federal government, because the banking system buys a lot of the issuance in the belly of the curve. So I thought that that was curious that what they did, and I was describing it as follows through that period, which was the necessary condition to end the rate hike cycle and start reversing at least the last three hikes, which I think were excessive, was disinflation. But they added a sufficient condition, which was a rise in unemployment and weaker growth. I didn't really understand that. You know, the so-called Phillips curve and Beveridge curve had gone vertical, meaning we weren't getting an increase in unemployment and wages were coming down. Well, that was the game and the rules all the way until the quiet period ended. And then suddenly Powell on Wednesday said, nope, Waller was right. If disinflation or if inflation comes down, we don't really care whether, the economy weakens or unemployment rate goes up. And that was a real game changer. I've maintained a underweight in small banks and in small caps, and largely because of my expectation that the economy needed to deteriorate to start that process of disinverting the curve. And then Powell just seemed to have thrown it all and changed it all on Wednesday. Williams tried to push back a little bit, but he was very unconvincing, in my opinion. He didn't really push back on that framework. So it was a curious meeting, to be sure.